everyone. My name is Christina Laney Mitre, and I am the team lead for Smart Living Hawaii's team. We are brokered by EXP, and today I wanted to talk to you guys about assumable loans, and I am introducing to you Judy Meredith, and she is the Hawaii area manager for PRMG and the also known as the mortgage professor because she teaches a lot of classes to us realtors and the community itself. So welcome, Judy.
Oh, thank you so much, Christina. What an honor to be here today with you. Smart Living Hawaii is obviously one of our favorite companies. You guys are so innovative. So I really appreciate you having me here today. And I look forward to talking about VA assumable loans with you today.
Yes, so this has been a hot topic, that we've been getting into because interest rates have been so high. And I think we've been seeing assumable loans all over the place. Some people are seeing them in their emails. People are learning about it. Someone will tell somebody about it or say, like, you should try this, or did you know that you can get an interest rate that's ridiculously low still right now? And there's always all these caveats and you know it's kind of like, is it for real? Is this true? Can you really do this? And so that's what we're going to be discussing today, and what it takes to do an assumable loan, what they are, and just kind of talk story with everything about assumable loans, and really hyper focusing today on VA assumable loans because it ends up being something that we cover a lot here in Hawaii because we have a lot of military and veterans that do come and go through our islands. So, anyhow, how would you like to start? Would we like to talk about the history of VA, assumable loans, and just other assumable loans as well?
Absolutely. So one tidbit that I love about VA loans. Obviously here at PRMG, which stands for Paramount Residential Mortgage Group, I am the Hawaii area manager, but I have been a loan officer for over 25 years, and I still perform my own transactions now. I've got some wonderful clients that I've been super successful, not only helping them buy their first homes, but also their children when they get older, their grandmas, everybody. We are really focused on generational lending and helping the family to build generational wealth. So we work with these families over time, and we make their dreams come true, which is amazing. But with that being said, one of the tidbits that most people do not know about VA loans is that VA loans were actually developed in 1946, and they were actually given as from the VA as a benefit to those that were coming back from the World War II. So as they were coming back from World War II, in lieu of a war bonus, they were given the biggest bonus of all, which is the ability to have 0% financing and to embark on this journey of home ownership that would allow the veterans to not only acquire housing for their families currently, but also give them a way to build their legacy by doing things like allowing their family members to assume loans. And what that basically means when they're assuming the loan is that they are taking over the loan from the veteran at the place where the veteran left off. And when we are talking about the history of VA loans, it originated with family members being in other veterans being able to assume the loans. But it truly wasn't until 1988 that they developed some reforms surrounding it and put in place some specific guidelines. So that's really when assumability came to the forefront here in America. And since then, obviously, it's evolved quite a bit, but that's definitely how it got its start.
Right. And there are a couple other options for assumables. You can't do any loan as an assumable, but you can do FHA and USDA. We aren't going to really go into those ones, but though they do have options for assuming those ones specifically. So I just wanted to add that in there. But where
Exactly.
would you like to go to next as we talk about assumable loans?
Well, I think we can probably talk about what exactly an assumption is and what it means. So what an assumption is that the current borrower, the person that originally purchased the home, who now would be the seller in this case. So what it is that when you have a seller that currently purchased their home with a VA loan, and they are able to identify another buyer that is able to assume the loan from them, meaning take on the loan at the exact space where they are leaving off. For example, that may be that if you had a buyer that purchased the home 2 years ago, so let's say that they purchased it in 2022, they would be 2 years into their mortgage. So they would have 28 years left. And let's say, by example, that they did take on 700,000 at that time as a loan amount. Given the opportunity that they borrowed $700,000 in their original loan amount, whatever the remaining balance is, the remaining principal balance, we would give that to the new buyer in the form of an assumption. Generally, the assumption needs to take place between veterans. So it would be veteran to veteran. And the reason for that is because of the certificate of eligibility or the eligibility of that veteran to use the home loan benefit. It is not a requirement that the new buyer on the property that's assuming the loan be a veteran. However, there must be the certificate of eligibility in place. So if the person who is assuming the new loan is not a veteran and they are not eligible for the VA benefit, then the seller who originally took on the loan would have to carry that VA benefit on their eligibility, which would then affect their ability to use that eligibility on any other properties. But that's in essence what an assumption is it's the seller with a current VA loan who will be then helping the buyer to assume or take on that loan from them at the space, at the loan amount and the amount of years that are remaining on that current loan term and under the current loan terms that the seller had signed originally with their lender, which is why you can get these great rates right now. I think we're going to go through an example later on in the road where your buyer was able to pick up 2.25 because they were able to purchase that home at a time when rates were phenomenal, which of course rates now are well into the 6% and definitely not anywhere near 2.25. So what a great, amazing transaction for your buyer, Christina.
Right. Actually, today we just closed on one of those assumption loans with a VA, and we did represent a buyer. And maybe we can, now that we understand what's happening with an assumption loan, maybe we can jump into why a seller or a buyer would look into doing this. And I think, like the pros and cons of things. For when I'm looking with our clients, to be honest, I was working with a seller recently and they had a 2.75, maybe a 2.25% interest rate, and they were VA. But they've owned the property for some time and there was over a $200,000 gap, right? Which means, they have some actual amount of money that's equity into the home at this point. So, for them and promoting an assumable loan, you can do, right? But realistically, if you're looking for a VA buyer to come into your property to assume that loan, that means they're going to need that $200,000 to $300,000 in cash to close on that property. So, just be wary when, people are out there or realtors are out there saying you can sell your home and have an assumable rate and advertise that it's so easy. It's not easy, and it doesn't, all the stars don't necessarily all align up, but sometimes they do, and the numbers make sense, and it's advantageous for both parties to move forward with, a situation like this. So in when you do have that situation where you have less down. And that, I mean, if it's a number under $100,000, I think or right around that price point, and you're looking at a home that's, I would say, maybe 6 to 1 million, per se, and it's under 100,000 that they're having to come to the table with, it might be manageable for, veterans to come in, or getting gift funds to help with this. But to be realistic, it's just over the price point. It's really hard to sit here and promote it for your property to try to get it sold. On the buyer side, when I work with buyers, and we had a situation in the one that we just closed on, they are looking at specifically properties that, a few years ago they can qualify for. They had a 2.25 interest rate, and now the interest rate, at the time was around like 7 or a little over 7%. And so that gap was so much that what they qualified for was significantly lower, and it wasn't a home that they were wanting to buy. So when we did start looking at assumptions, we started looking at how much they owed on the property. We did kind of pull options and see what came up, and someone did promote that it had an assumption, and it was definitely doable for our clients because they can come up with a down payment that was reasonable. So I think we will go into an example of doing an assumable loan with this specific case, so you can kind of see, apples to apples, versus a VA regular loan and then a VA assumable loan, and what the numbers and breakdown looks like for monthlies and for, your in costs and what you have to pay at closing. So that's what I have to say on, I guess, the sellers and the buyer side as to advantageous things to do. We can talk about pros and cons. Did you want to talk about pros and cons next?
Yeah, well, I think that what you brought up, Christina, is 100% dead on. The reality of it is when it comes to whether it's a new mortgage or whether it's an assumed mortgage, it doesn't matter, right? That is really serious stuff. So for anyone to haphazardly treat it as easy or no problem, that's definitely always the wrong approach, right? Because the reality of it is home ownership is serious. It takes preparation, it takes planning. The steps have to be concrete. You've got to be working with a secure, solid team. You've got to have a great real estate agent that's knowledgeable and educated in every arena, as well as a seasoned, knowledgeable loan officer that's able to guide you through and provide the correct answers so that you are taking the correct steps as they come forward, so that you can maximize your rate of success and obviously become that successful homeowner that you've dreamed about. So, haphazardly jumping into something without proper preparation is definitely not the way that you want to do it. So videos like this that you're doing are so amazing because that allows education to be broadcasted to the general public so that they do have awareness about the different types of transactions and how assumability could affect the transaction. And you're absolutely right. There's a lot of differences when it comes to taking on a traditional transaction or in this case, a new VA mortgage versus an assumed VA mortgage. And I've got a spreadsheet presentation that I'm going to pull up right now. So let me go ahead and show my screen and then we can talk a little bit about that. All right.
Yeah, and for those of you who are just listening in, not necessarily, looking at the screen, you can definitely go to YouTube and watch this later. But we will try to explain it to where you can visually, mentally see what we're visually showing, if that makes sense.
Absolutely. Absolutely. So let me go ahead and show my screen. So this would be an example of taking on a new VA loan versus taking on the VA assumed loan. And we are going to use the example on the property. Congratulations, Christina, on your closing today. That you closed on, because I think that what you brought up earlier as far as the appraisal gap, and when we talk about an appraisal gap, what we're talking about is going back to the earlier definition of what an assumed loan is, taking on that mortgage from the seller at that snapshot of where he ended at, and then that buyer coming in and taking it in that space. Now, and under those terms. Now, remember, just like Christina had mentioned, there's going to be some equity built into that home that the seller is going to want to cash out on. And that's the gap that we're referring to. What is the difference between the purchase price and the amount of loan that is going to be assumed? If that amount is a little bit smaller, then it is an easier amount to mitigate, just as Christina had mentioned about possibly having 50, 60, or 100,000. Once you get into $200,000, $300,000, $400,000, $500,000, that's when it could be very, very challenging for a buyer to come up with that much cash to fill that gap. So with that being said, when we look at the purchase price here for a VA loan that is new and the VA loan that's assumed, we're using the same purchase price. So nothing here has changed. And even for the loan amount, as long as the buyer is willing to bring in the same amount of down payment that they were looking forward to, which in this case was $60,000, the loan amount that they would be borrowing is the same. However, with the new loan, the VA buyer does have the opportunity to borrow at a zero down capability. So that is another option, but in this example, because we wanted to keep it apples to apples, we wanted to use the same loan amount, because what we're really showcasing here is the differences in rate, the differences in payment, and the differences in overall closing costs and cash to close. So for a new VA loan, you'd be looking at an interest rate today, right about 6.25%. Whereas in this assumed loan scenario, they were able to pick up an interest rate of 2.25. And let me say, that is sexy, right? That is so sexy. And for so many different reasons why. And also here we go with the term. So when it comes to the term of the loan, a new loan would have 360 months, which is a new, fresh 30-year term. However, because the assumed loan is taken at the snapshot of where the seller is leaving off on the terms of the loan and the buyer is picking it up, he will pick up the remaining months as well. So it looked in this example that this seller had been in the home for about 2 years. So what that means is that this new buyer will have a 28-year loan rather than a 30-year loan, which is substantial, right? That's 2 years earlier that he can retire and
Yeah,
stop
and
paying his
usually you
bills.
pay so much in interest versus principal in those first few years. So
Exactly, exactly. But look at this, and this is where it really gets amazing, is underneath the new loan, you'd be looking at a new payment, principal, interest, taxes, and insurances of roughly $4,665.81. Whereas with the assumed loan, the payment is $3,155, which is this difference right here. $1,510.81. $1,500 difference that this buyer was able to save per month through the being able to assume a loan rather than get a new traditional VA loan. In addition to that, there are substantial closing cost differences, which is why we do see the cash to close here on the new traditional loan right about 78, 171.59, whereas we see it here 66,309. So let's see why those differences are. I'm just going to push this button here for more info, and it's going to give us the payment breakdowns so that we can take a look at that. So here for the payment breakdowns for a new VA loan, remember when we have a mortgage, we've got principal, interest, taxes, and insurances. So principal and interest, right about $43.40. Property taxes at $200. Homeowners insurance here in Hawaii, you've got to carry hazard insurance, which is generally your fire and your liability, as well as hurricane insurance, which is not the case for all states. So it's specific to Hawaii. And then of course you had flood insurance. That would be a whole nother animal and that we would have to build into here too. But this particular home was not subject to flood insurance. So the total payment, PITI, as we refer to it, or PITI, is $4,665. Whereas with the VA assumed loan, you're looking at principal and interest, and this is where the interest rate affects the entire transaction, right? Because your payment is that $1,500 less, $2,830. Everything else is going to be the same. The taxes, the insurances, none of that will change, but the overall payment is going to run about $1,500 less, which is why this was just such a smoking hot transaction for this particular buyer.
Yeah. And this was actually done back in November when we went into escrow, and the interest rates were actually higher than
Higher at
this.
that
I want to
time.
say it was like in the sevens or so. And so because of that, I mean, that gap of 1,500, it was actually much more than that because, it was almost a point higher. So,
Exactly.
yeah.
Exactly. 100% true. And then if we click the closing cost button, this will take us into what the closing costs are. So when we are taking on a new VA loan, we are subject to all of the different costs. Remember, when there is a closing cost associated, or settlement costs, as they're really referred to in the industry, it encompasses virtually every company that has touched that mortgage. Everything from the mortgage company to the title company to the escrow company to the appraiser that goes out to the property. And when we are doing a VA loan assumption, the majority of those fees will actually go away. And this is what we mean. So when we are looking at a new VA loan, these APR costs would be indicative of, say, a processing fee, and under a lender's processing fee, and a lender's underwriting fee, a title company's escrow fee or settlement fee, and title's new title policy, along with the appraiser and some of the other costs that go into making the loan. So that's why you see here that APR costs, annual percentage rate costs that are blended into the APR, are right about $3,900. And then non-APR costs would be some of your title charges, which would be roughly in this case about $3,600. Also, when you are working with a VA loan, there is a funding fee. This particular buyer put down more than 5%. So because of that, his funding fee was only 1.5%. However, and I'm going to segue here, the VA does put forth an actual funding fee of what the fees will be for veterans. And they are either going to be calculated, and everybody has to go along with this grid. The VA does put forth an actual funding fee of what the fees will be for veterans. And they are either going to be calculated, and everybody has to go along with this grid. Because the VA funding fee does not go to the lender, it actually goes to the VA. So what it does is the veteran passing through the doorway of homeownership will pay this VA fee, VA funding fee, which in essence keeps the doors open and the program running for the veterans behind them. And based upon their service, based upon their down payment level, and based upon whether they are a disabled or a veteran that may be exempt from the funding fee, all lenders will go to this grid. And then based upon the amount of whether it's a purchase or a refinance, and in this case, we're just talking about purchases, and whether or not they've got a down payment, whether it's 0, 5 to 9.99%, 10% or more, or if it's a refinance. But then we would take a look at first time use, which is generally less. So a veteran on first time use would be 2.15, whereas if this was their second home or second use of the VA benefit, it would be 3.3. In this case, because the buyers are purchasing a home, they are putting down about 7%. Their funding fee, whether it's a first time use or second time use, is 1.5% if they're taking on a new loan. And that's where the savings start for an assumable loan. Because when we are dealing with an assumed loan, you will be looking at 0.5%. So right there, look at what the difference is on the funding fee from 1.5% to 0.5%. It's
About
over
seven.
$7,000 savings. And then on top of that, once you take into in the account all of the other loans, it roughly is about a $12,000 savings overall in closing costs and funding fee to the veteran. And that's why assumptions are amazing if all of the pieces of the puzzle can come together.
Right. So as we see here, we see, wow, this looks so amazing. Why is this not happening everywhere, all across the board? Well, there's several reasons, and now we're going to talk about the cons, I would say, or the hurdles that you face when you're dealing with an assumable loan. So some of the things that are very important, and Judy had mentioned this, is you're needing to have an agent, a realtor that's working for you if you represent the buyer or the seller, you're either one, that you want both parties, whether it's the listing agent or the buyer's agent, to really understand how assumable loans work, the whole process, what you have to go through, the timing it takes, the different tips that you need to know in order to move that loan through, for your clients, and to make sure the expectations are listed, and the things that are going to happen through the process that you're that we're informing all of the parties about what's going on, so it doesn't alarm either the buyer or seller. So it is very important to have, anybody that's working on your team, or even on the other side, that they do know what's going on and have done assumables before. And in this case, some of the hurdles that you face is time. So in this situation, I mean, you can do, Judy, what are like some typical times that you would say a VA can get through under 30 days? Is that pretty common nowadays, right? Under 30 days. So you can do a regular VA loan that quickly, right? And if you are looking at an assumable loan and that's VA, I would say the fastest is 2.5 months. I mean, we were probably very close to that, about 2.5 months. And that's pretty quick. I mean, when you talk to a lot of people that attempt assumable loans and maybe they didn't go all the way through, they're still in escrow 6 months down the line, and they're very frustrated and they pull out, and it just doesn't seem to work out for them. But there's different reasons why. So timing is one thing. And that's kind of, I think, a big thing for people if they're having to move in, and veterans usually do. I mean, things are very timely for them, and they're moving in because they're PCSing or whatever it ends up being, and they need to get into their place right away. So this is one hurdle that people face. If you can't wait, then this is something you have to consider. Another hurdle that you face is just that if you do not have, as a buyer, all your ducks in a line, then it will hold up the process. And just to put things into perspective for some of you, this is not for a bank that has that loan already. They're not incentivized to do this, but they are required by law to do this, right? To transfer these loans and have others assume them. And they do have to facilitate the process. Some banks that we worked with this last one, talking to them, they were doing maybe 3 a year, right? So it was very manageable. And now they're doing over 300 in a year, and they haven't increased
Staff.
their staff to do this, right? Because increasing their staff requires to be hiring more staff for a program that doesn't generate money
Right. It's not a
for
revenue
the bank.
maker.
So it doesn't there's no money that's coming in. They're really making, I think on ours was about $300 for that assumable fee. That's just the, paperwork and processing for that bank to transfer everything over. But it does take that 2.5, 3 months, 6 months of time that you're working and going back and forth with that bank, and there's a specific person there handling these things. So, on our end, we work very closely with them. We are very tight with our buyers and making sure that they're getting everything that they need over to that bank the second they're asking for it. In addition to deadlines and, when you're needing specific things, it's like you have to hurry up and get your stuff, and then you wait. And then you wait and you pray and you think, God, I hope they look at our file this week. And you don't want to sit there and hound them, because then it aggravates things, obviously, especially if they're stressed out with too many cases. But at the same time, you do spend enough time with them, and if they see that they're working with a professional that knows the process, I think that also ensures them to move, that they can move quickly with your file and not like put it at the bottom when, you don't get something to them right away. Right. So those are kinds of things that we're always doing with our clients. I don't know if you've ever worked with short sales, if anybody has, but we have done short sales as well. And there is that similar process of how things go and how things build up. And, you do have to learn to work with the processor that you're working with, and, build a rapport with them, and let them know that you are there to get them whatever they need when they need it. And I think that helps along the way to make the process as quick as it can be. So that was on our end, and what we have to deal with when you're doing everything. I do know, and the loan ratio, what is it for a regular loan for ratios? For I know this was
Yeah.
41%.
Are
What
you
is it
referring to
for?
a debt to income ratio?
Yeah, yeah.
Mhm.
What is it for you? Is it the same or is it different?
So assumable loans technically should be following the same guidelines as a traditional loan. However, every lender can place on their own overlays. And what that means is that the traditional VA guideline is written with a lot of flexibility. That's one of the benefits of the VA loan, is the flexibility. But as a servicer, or the bank, they can add whatever additional guidelines that they want. And many of them will place an additional guideline when it comes to debt to income ratio, because it does reduce the risking of the loan. Obviously, the lower your debts are and the lower your monthly payment exposures are, that's going to be a safer space for the lender. So many of the lenders in an assumption situation may limit it to 41, 43. I've even seen 39% as an overlay. So it really depends on the servicer. And I think that what you mentioned is the most important thing that most folks do not know about a VA assumable loan, is that you don't get to go out and choose your favorite loan officer. You don't get to work with the company that you want to work with. You are forced to work with the people who are currently holding the loan, which is the seller's lender. And as you had mentioned, that particular lender, because these transactions, these assumable transactions are non-revenue generating for the bank, they do take the back burner, which is why it can affect your timeline. So where you're working on a traditional VA loan with a great loan officer, they are going to be mindful of your purchase contract dates, right? When is your closing date? We need to meet that closing date because that is our job to stay within these timelines. When you are going for an assumable loan, though, those timelines go completely outside of the window. And buyer and seller must agree that they are fine with waiting however long it takes for that lender to get through the paperwork. And depending upon their staffing, depending upon how many people they've got, waiting in line for their assumed loan, that could definitely take it from, 2 months to 3 months to 6 months, or possibly not even getting the assumption if there is something specialized with your loan that would need a special underwriting consideration. Because that's definitely something that you're not going to get at the assumable desk. When we are working with the seller's lender and they are understaffed and there is a long line of assumptions coming your way, there is going to be, the opposite of flexible underwriting criteria. So this is really where you're going to have to fit into that box, that cookie cutter box. And if you do have specialized circumstances that needs a particular hat of expertise, you're probably not going to experience that at the assumable desk. And that's where it may be more beneficial to go with a lender on a new VA loan if you have criteria that is just not able to fit into the box that the seller's lender has presented for you.
Right. And since we're talking about this and how, the cons may dissuade you, I did want to mention that when you do actually go in for an assumable loan, one thing that you do need is you need help from someone like Judy, who is a lender willing to work with with you as a buyer, even though she isn't going to be handling that loan, she's going to be there to help get you started with this assumable loan because of her heart. She cares. She cares for her clients, and this is what I love most about her is that she genuinely does. If, you know, I've talked to numerous lenders, and if you talk to them about assumable loans, they just turn around, start walking away. But Judy's like right there, like, let's do this podcast. Let's do this chat on this because it is a very good thing for the right person, right? And she's one of those people that they're going to be like, maybe not this time, or maybe you give me a referral, or maybe it be something that she helps next time, or maybe this doesn't even work out, and then you definitely still need somebody, and the interest rates drop in a few months. Who knows, right? And then there's Judy, right? Ready to serve you either way. So, I mean, maybe you can talk about what you do if there is somebody interested and I bring you a buyer and
Yeah.
how you can help.
Well, thank you, Christina. What a wonderful compliment. And that's one of the reasons why I love working with you also. I think that we share that same philosophy, that we're there to do what's best for the buyers, regardless of how it may reflect back on us, meaning our pocketbook or commissions or whatever the case may be. I like to say that I don't deal in mortgages, I deal in relationships. My relationship with you, my relationship with that buyer, and my focus on making sure that that buyer is getting the best transaction, whether it's with PRMG or whether it's with someone else, and educating them along the way so that they can become a successful homeowner. So when you are referring your buyer to me, my job as a expert loan officer as well as an educator is to prepare them for the transaction. So we will completely vet them for whatever purchase it is that they want to take on and whatever purchase price that is that they need to attain. So that is our job first and foremost. If they are able and are lucky enough to find a property with you that has an assumable loan, then what we will do is we will actually continue with that pre-approval, and we will have the underwriter take a look at it to make sure that they are fully pre-approved. whether it's for our loan or whether it's for that assumable loan, so that you have the confidence, whether the property has an assumable loan or not, that you've got the confidence that this buyer is going to qualify for that loan amount that's requested. And then obviously, if we can get them an assumable loan at 2.25% versus 6.25%, it's going to be that much easier for them to qualify. But what that really does is it educates them, it prepares them, and it gives everyone in the transaction the confidence that this buyer is going to be able to perform. Because when you have an assumable transaction, once again, it's a negotiation between buyer and seller. So not only does the buyer have to qualify, but the buyer has to qualify with the seller's lender and the seller's terms and the seller's
Right.
loan. So they've actually got to be on the same page when those things happen. So, and because these transactions be this, just like we talked about, the timeline can be affected by the assumption, it can stretch out for long periods of time. Your negotiation with the seller is going to be greatly affected by whether or not that buyer can actually perform on that loan. Wouldn't it be terrible if the buyer said, was not pre-approved, that they said, yes, seller, I'll be able to perform on this. The seller waits 3, 4, 5, 6 months to find out that they were never qualified to begin with. And now they've got to begin with another buyer at the very, very beginning. And that's even worse if, let's say, the property was vacant and the seller was carrying the mortgage the entire time because they'd already left the island on their last, move, their last job change or their last station change. So that's why it's so very important that you're working with a lender that's really willing to do what's best for the buyer, regardless of what the bottom line for their revenue may be. Because we are here to help the buyers with the best program, whether it's with us or not. And the reality of it is that buyer eventually, like I said, is going to have a friend that needs to buy something. They're going to become a seller later on if they choose to sell that property. They'll be in a position again. And if you and I are doing our jobs right, we will teach them how to leverage their first asset or their first purchase and become an investor and ultimately end up with that dream home that they've always dreamed about, which may be at a much higher price point. And because of that, they may be able to retain that property and rent it, or they may be able to sell that property and use the down payment and the savings that they were able to acquire during the first purchase to leverage that second purchase. So there's so many different reasons why we want to maintain the relationships and really make that a priority over any type of monetary reward.
For sure. And that's a huge thing. It's actually it was a requirement for our last one that we actually gave them, a pre-qualified, from another lender, not them, right? They wanted to see something to show that you did our clients do qualify for the property. And so that's why I say, it's always best to, I mean, in this situation, Judy, you would be their lender because at the end of the day, they don't really feel like they have a lender. I mean,
Right.
they're just working directly with the bank, right? So, when they go home and they talk about their lender, it would be you. And they would be like, you need to use Judy. So I mean, when you think about it, it is the relationship, and that's how we always do our business as well. And doing it with someone, not only just the integrity, but the knowledge and the competency of, assumable loans is what really makes it actually go through. So, I mean, if I were to, if we were to end right now, I would say that is more of like, you need to be working with, a really good team that's going to be there to support you through the whole thing and know all the steps and forewarn you like, hey, this is going to be a challenge and these are the hurdles we're going to face, so you're not wondering like, why is this taking so long or what have you, because you're already going to have these expectations lined up front, and that will be for the buyer and the seller, right? And then things will go smoother when you have the right expectations. So
Absolutely. And you are right on the money when you said that setting the correct expectation is really the most important thing. And preparedness and education is always going to be a huge caveat to that.
so Without further ado, thank you so much, Judy, for being here and jumping in on the lending side and sharing your knowledge with us. And maybe you can share with us your YouTube channel as well, because you have a lot to share. She teaches a lot of classes for us agents, along with buyers and others in the industry and the community. So please share.
Oh, thank you, Christina. So yes, I've got my own YouTube channel. It is under the handle Judy, the Mortgage Professor. And as Christina had mentioned, we teach here at PRMG, we teach not only in addition to all of the other things that we do, we also do a lot of community outreach and educational outreach. So community seminars for first-time home buyers, investors, all different kinds of topics to make sure that we're really bringing the relevant information to the community. And then in addition to that, real estate agents and loan officers, because we are licensed, we do have to take continuing education every year. And so what we do is we provide continuing education for our realtor partners, once again, just to make sure that we are sharing the most up-to-date informational pieces with them so that they can really blossom in their careers, as well as gain these really necessary credits to move forward in their licensing. So I'm just really honored that they want to listen to me talk. I always wonder, why would you do that? But so wonderful. Thank you so much for supporting me, and thank you for having me today. What a wonderful topic. And I was so grateful that you asked me to do this with you. So thank you, Christina.
Awesome. I think we're going to have you on for more of lending topics of discussion for our future podcast and platform. Thank you so much.
I'd be happy. Thank you so much, Christina. Bye-bye.
Bye.